If you can't explain what a 3.75% bank rate means for your wallet, you need this video. I'm Hamid from Wealth Decoders. The Bank of England just made a decision that affects every single person in the UK. Your savings, your mortgage, your investments, everything is just shifted. And most people are completely asleep at the wheel. In the next few minutes, I'm giving you the exact playbook, what this rate hold means, why the bank made this call, and the specific money moves you need to make right now in 2026. Savers, mortgage holders, investors, nobody lives without a game plan. Stick around because the final strategy is the one nobody's talking about. Here's the truth. The Monetary Policy Committee voted to hold at 3.75%, but the vote was split. Multiple members wanted to cut rates further. This wasn't unanimous confidence. This was a divided room. According to the Bank of England on May 2026 minutes, the committee weighed persistent services inflation against weakening GDP growth. That tension, it tells us everything. Let me give you context. In 2022, the bank rate was just 0.1%. Then inflation exploded. The bank hiked aggressively, peaking at 5.25% in late 2023. They started cutting in 2024 and brought it down to 4.5%. Then more cuts in early 2025 brought us to 3.75%. And now they've paused. This is where it gets absolutely crazy. Most people don't know UK CPI inflation is still running above the 2% target. The ONS reported headline inflation at 2.6% in early 2026, but services inflation still above 4%. Professor Silvana Tenrero, former MPC member at the London School of Economics, warned that services inflation is the hardest component to tame. The bank can cut when wages and services keep prices elevated. Here's what changed everything. While inflation stays sticky, the UK economy is barely growing. The Office for Budget Responsibility projected just 1.1% GDP growth for 2026. Dr. Jonathan Haskell, former MPC member and Imperial College London professor, published research in 2025 showing that rate holds during low growth periods create a dangerous squeeze on consumer spending. The bank is walking a tightrope, and coming up, I'll reveal what this means for your mortgage. Let's be real. If your money is sitting in a current account earning 0.5%, you're losing purchasing power every single day. Inflation at 2.6% means your money shrinks in real terms. But here's the game changer. Easy Access savings accounts are still offering 4.2% to 4.6% right now in 2026. According to Moneyfacts data, the average Easy Access rate is 3.2%. But the top accounts crush that. You need to switch immediately. Nobody tells you this. Fixed rate savings bonds price in future rate cuts. That means the market expects the bank to cut later in 2026. One-year fixes are already dropping toward 4%. If you believe rates will fall, and swap markets agree, locking in a one-year fix at 4.3% right now is a steal. The window is closing. Once the bank signals the next cut, these rates vanish overnight. Most of you are sleeping on this. Here's the truth. This is the question keeping millions of Brits up at night. Fix or go variable. Right now, the average 2-year fixed mortgage sits around 4.4% according to Moneyfacts. 5-year fixes are hovering near 4.1%. Variable trackers are lower at around 3.9%. But here's the insane part. If the bank cuts twice more this year, variable rates could drop below 3.5%. That's a massive difference on a $250,000 mortgage. Imagine this. You have a $250,000 mortgage over 25 years. At 4.4% fixed, your monthly payment is roughly $1,375. But on a tracker at 3.5% after 2 cuts, it drops to $175. That's $200 a month, $2,400 a year. Over 5 years, that's $12,000 saved. But the risk is rates don't fall. That's the gamble. Professor Michael McMahon at the University of Oxford published research in 2024 showing that households consistently overestimate future rate cuts. Don't be that person. Here's what changed everything. Rate holds create a golden window for investors. When rates pause, bond prices stabilize. UK gilt yields on 10-year bonds are sitting around 4.1%. That's a real return above inflation. And the FTSE 100, it's been on a tear in 2026. When rates hold steady, equities tend to rally because businesses can plan. Coming up, I'll reveal the one asset class that explodes when rates finally drop. Most people don't know. When interest rates fall, bond prices rise. It's an inverse relationship. If you buy gilts or bond funds and now at 4.1% yield, and the bank cuts to 3% by 2027, your bonds appreciate in value and pay income. A 2023 study by Professor Andrew Clare at Bayes Business School, City University of London, showed that investors who bought bonds 6 months before rate cuts outperformed cash savers by an average of 8% over 2 years. That's not a small edge, that's life-changing. Let's be real, the UK property market is in a weird spot. Rightmove 5 data shows asking prices up 1.4% year on year in 2026. Not crashing, not booming, just waiting. A rate hold keeps mortgage costs stable, which supports demand. With incomes come, first-time buyers flood back in. If you're thinking of buying, the hold gives you time to prepare. Get your deposit locked in a high-interest account. Get your mortgage agreement in principle. Be ready to move. Here's a pattern interrupt for you. A 2025 survey by the Financial Conduct Authority found that 72% of UK adults have never switched their savings account. 72%? That means nearly 3 out of 4 people are earning the default rate their bank gives them. While top accounts pay 4.6%, the average person earns under 2%. That's thousands of pounds lost over a decade. If you're not doing this in 2026, you're literally leaving money on the table. Stop it. Nobody tells you this. Swap markets are already pricing in 2 more cuts by end of 2026. That would bring the bank rate to around 3.25%. The next MPC meeting is the one to watch. Economists at Goldman Sachs and Barclays both forecast at least 1 cut before September 2026. If inflation cooperates and GDP stays weak, the bank's hand will be forced. The question isn't if rates fall, it's when. And the people who prepare now win big. Here's the truth. I'm going to give you the exact 5 moves. 1. Switch your savings to a top-paying account today. 2. If your mortgage deal expires soon, compare fixed and tracker rates carefully. 3. Open a stocks and shares ISA and consider bond funds. 4. Build your emergency fund in a high-interest account. 5. Stop panic watching headlines and follow the data. This playbook works whether rates hold, cut, or even rise. Imagine this. You move $20,000 from a 0.5% account to a 4.5% account. In 1 year, that's $800 more in interest. Over 5 years with compounding, that's over $40 times $500 of free money. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the math doesn't lie. Every single day you delay switching is money you will never get back. The rate hold gives you this window. Don't waste it. Here's what separates wealthy people from everyone else. They don't react to rate decisions with fear. They react with strategy. Every Bank of England announcement is a signal, a data point, an opportunity to adjust. Dr. Brad Clontz, a financial psychologist at Creighton University, found that people with a proactive money mindset accumulate 3 to 5 times more wealth over their lifetime than reactive decision makers. Be proactive, not reactive. That's the wealth decoders way. Let me tie it all together. The Bank of England held at 3.75%. Inflation is sticky but falling. GDP is weak. Cuts are coming, probably by autumn 2026. Savings rates are high right now, but won't last. Mortgage holders have a window to lock in great deals. Investors should position for falling rates with bonds and equities. This is your moment. The rate hold isn't boring news. It's a launch pad for anyone paying attention. And you are paying attention. If this video hit different, I need you to do 3 things right now. 1, smash that subscribe button and hit the bell so you never miss a Wealth Decoders breakdown. 2, drop a comment telling me your biggest money move in 2026. 3, share this with someone who needs to hear it. I read every single comment. Your financial future starts with the decisions you make today. I'm Hamid. I'll see you in the next one. Let's build wealth together.